Okay. So Samudra, Vaibhav, we can start.
Sure,
Yeah.
Rahul.
Okay. Hello everyone. My name is Rahul. I'm from Valtrust Capital, and as we all aware that we came up, we had our union budget yesterday, and while a plethora of things was discussed, we wanted to kind of bring out the key highlights. And to do that, we have Vaibhav and Samudra here, who are from Dhruva Advisors. Vaibhav is a partner, and Samudra is an associate partner at Dhruva. What we'll be doing today is essentially discussing the key highlights that the budget had, specifically from an investor perspective, right? So while the budget had a lot to cover, we are going to be focusing on few parts of that. Of course, if you have any questions, please feel to put it in the Q&A box, or send an email afterwards, right? Let's start. I think Samudra, Vaibhav, we had the budget yesterday. A lot of incentives given. A lot of talk was around employment, around MPS. But the key thing that everyone kind of talked about is, of course, the change in the capital gain, right? And some of the changes in the new tax regime. With the remove of indexation, I think there are a lot of questions, and a lot of people are trying to understand what it means for them, what it means for the investment, at what time it will become beneficial, and at what time it doesn't become beneficial compared to what we had earlier, right? So I think it'll be good to kind of start off with, to get some views that you both have on the budget we had yesterday, and then kind of straight away jump into what changes were there in the capital gain tax, and what changes were there, income tax, etc.
Sure. Thank you. Thank you, Rahul. And good afternoon, everyone. Thank you for joining us today, this afternoon. It's indeed a privilege. Presented its first budget in the third term. And one word on the budget as to if there's a theme to the budget, I would say it's consumption. So the budget really is focused on consumption, on for personal incomes, whether it is increase in the standard deduction or changing with the tax slabs on the new tax regime, or significant changes in the capital gain, some of which we'll see in detail as we go forward. I think the objective really is to promote consumption in the economy, on generation of employment and skilling of people, while keeping the momentum on infrastructure and capex in place. Announcement that I could see yesterday was the announcement on a substantial review of the entire income tax law, which with the finance minister announced that they would be doing a review in the next 6 months with the objective to simplify taxes, rationalize taxes, reduce litigation, reduce tax uncertainty. And I think that's a very, very important change. And if I were to reflect on it, in some form and shape, an exercise like this was done many years ago, when the income tax law was effectively rewritten in the form of the direct tax code, which many of us would remember in 2010, but that never saw the light of the day. Hopefully, with this new government and its commitment towards simplifying the entire tax system, tax administration, hopefully we'll see progress on this front, and maybe the budget that we see next year should hopefully have more announcements based on the review that the government carries out. The other important announcement that came in the budget yesterday was on the entire foreign investment and overseas investment policy, and it was more like a motherhood statement from the finance minister to say that the government is committed to simplifying the foreign investment laws with the objective to encourage and attract more foreign investment, which is very welcome. However, the other big announcement that came in was on trying to promote Indian rupee, the Indian currency, as the currency for making foreign investments. And if that happens, I think that would be a revolutionary change that comes in terms of making the Indian rupee, freely convertible and transactable on the overseas markets. Today, what we're going to do is we'll discuss some of the substantive changes on the income tax laws that have been announced, which would impact family offices and high net worth families. We'll keep the discussion. So we've got the slides for you. We'll maybe run the slides for about 30 to 40 minutes. And then at the end of the session, very happy to discuss some of the questions that you may have. With this, I invite my colleague Samudra Acharya to take us through some of the changes that have been announced.
Thanks, Vaibhav. Good afternoon, everybody, and welcome to the webinar. There have been some impactful changes in the current proposal. So we will start with the capital gains provision. And the first one is the period of holding. So till now, we had different period of holding for different classes of assets. Like in case of immovable property, it was 24 months. In case of listed shares, it was 12 months. And in case of all other classes of assets, it was 36 months. But now there are only two categories. One, for the listed securities, including any units, is 12 months. And in case of all other classes of capital assets, including unlisted securities, real estate, gold, etc., it's 24 months. So in a nutshell, the overall short-term holding period has been reduced to the period of holding. Now, next is the tax rates. Again, we used to have different long-term capital gain tax rates for different classes of assets. In case of listed shares, it was 10%. In case of other classes of capital assets, it was generally 20%. Now they have made it flat, 1.5%. Irrespective of the class of assets and irrespective of who is holding, whether resident or non-resident. It's a flat rate. Now, one key change for the residents, and that is indexation benefit will not be available going forward. What it means is that going forward, if any resident sells any long-term capital asset, say immovable property, he won't be able to get offset of index cost against the sales consideration, but he will only get the offset of the base cost. However, in respect of non-residents, the provisions on foreign forex exchange on the capital gains computation that will be available to them. Further, if anybody is holding any asset prior to April 1, 2001, he will have the ability to rebase the cost based on the fair market value of that asset as on April 1, 2001. So these two provisions are still available, but indexation provision is now not available. Further, as you will know, that when we sell the listed shares or MF, we get an exemption of 1 lakh rupees. Now this exemption limit has been increased from 1 lakh to 1.25 lakhs. In respect of equity shares, MFs and trust, units of a trust, the short-term capital gains tax rate has been increased from 15 to 20%. And the most critical one, which we believe, is that if you are holding any unlisted bonds or debentures, from now on, it will be treated as a short-term capital asset, irrespective of the period of holding, and it will be subject to the slab rate or the MRR. Earlier, what used to happen was when you were holding the unlisted bonds and debentures, depending on the period of holding, it would have been a short-term asset or a long-term asset, and it would have been taxed accordingly based on the applicable rates of long-term and short-term. So this is a big change, I believe. So all these amendments are applicable from July 23, 2024 onwards. So these are some of the key capital gains amendments. So in this slide, what we have done is we have provided a snapshot of the LTCG tax rate and the STCG tax rate considering the class of capital asset and the period of holding. The table is self-explanatory, still we will run through it. Now say the asset class is listed shares, equity mutual fund or ETFs. If the holding period is more than 12 months, it will be considered as a long term. The long-term tax rate will be 12.5%, and the short-term tax rate will be 20%. where the asset class is unlisted shares, it will become long-term only if the holding period is more than 24 months. The LTC rate is flat, as you can see in every case, 12.5%. However, the tax rate, STCG tax rate will be the slab rate or the MMR. In case of SMF, Specified Mutual Fund, stroke MLD, which is market-linked debenture, it will always be considered as a short term. As we know, this has already been proposed under earlier budget. And it is taxed at MMR, stroke slab rate, the maximum rate. In case of listed debenture bonds, it will be considered as a long term if it is held for more than 12 months. Long term rate is 12.5, short term rate is MMR. Unlisted debenture bonds, we just discussed. From now on, it will be considered as a short term always, and it will be taxed at a MMR. As far as REIT units or InvIT units are concerned, they will be considered as long term if held for more than 12 months. The long term rate will be 12.5%, and the short term will be 20%. In respect of immovable property, the period of holding, if it is more than 24 months, again it will be long term. The long term rate will be 12.5, and the short term rate will be MM. So this is just a snapshot, and this will be applicable both for.
Yeah. So,
Sorry, Rahul, you have.
Samudra, thanks for this. Now, so that's fairly interesting, right? Because a lot of the things that we had before in terms of 10 and 15% have changed. And it's very evident that the long-term capital gain, short-term capital gain on the equity is increased. And I think that's really understood by everyone very well. But can you point out the 2-3 really big changes that have happened, and are they going to be beneficial or not compared to, say, for example, in terms of your debt mutual funds or in terms of, your real estate? Because those were the really big ones, right? Which had some benefit in terms of indexation, etc. But now with the indexation gone, it'll be interesting to kind of know what do you guys see as the really big impactful change that's come on, on the capital gain side.
Yeah. So one of the important change I would say is that on the unlisted debenture and bonds. So I have also covered it here, especially in respect of non-residents. Now, what used to happen was when a non-resident was holding any unlisted debenture and bonds, which was in long-term nature, that is more than 36 months, and when they used to sell it, the tax rate was 10%. Now, since this has been now be considered as a short-term instrument, irrespective of period of holding, the tax rate is now 35%. So this is a sharp increase that ways.
So Rahul, if I may come in here, imagine a foreign investor, right? FDI investor, a private equity fund, wherein, as we are aware, compulsorily convertible debentures are a very favored kind of instrument for FDI investments into India, right? Until now, these private equity or foreign investors were paying a capital gains tax of 10% on transfer of such CCDs after holding them for 36 months. That tax rate now has moved 3.5 times up. It's moved to 35%, effectively killing the entire CCD as an option for funding instruments. I think that's a very big change as far as non-residents are concerned and as far as FDI is concerned.
And one of the ways to even neutralize it, it is still initial period, that before transferring these instruments, you can think of converting them into equity and something like that, just to safeguard on some sort of tax impact. That's initial reaction, I'll say.
Okay.
And I think one of the other big change really, Rahul, which will impact, high net worth families is on real estate. Again, while the tax rate has been reduced significantly from 20 to 12.5, however, taking away the cost indexation benefit is a big one. And we've got an example to really look at, a scenario as to what is kind of looking like a neutralizing scenario where the entire, benefit of reduction in the tax rate is getting offset by the taking away of the indexation benefit. And that's again a very, very important change. And the third thing that I would, think is more on mutual funds, debt mutual funds. There, I think there's a very, very interesting amendment which is welcome, where if you see earlier, the way these specified mutual funds were defined, they basically were covering a whole gamut of mutual funds, barring those which were investing, only in equities, only in domestic equities, right? That's how the definition was. Now they have changed the definition, and they've actually, in that sense, reversed the definition to say that any mutual fund which is investing more than 65% of its proceeds in, debt and money market instruments, only those mutual funds will be considered as short-term capital asset irrespective of the period of holding. Which, in that sense, at least takes away the stringent provisions from funds like an exchange traded fund or a gold ETF, gold mutual fund, or even for that matter, an overseas equity fund, right? Which were otherwise, in the last year's amendment, they were in that sense caught in that, in that definition.
Yeah.
So I think that's an important change. It was a demand of the industry also to really, keep the stringent provisions to pure debt funds and not extend them to other kinds of funds. So I think that's an interesting amendment. However, having said that, that amendment will take effect only from 1st April 26, which is next year. This is assessment year, so financial year 25-26. So only any transfers happening post that date will enjoy this benefit. So if anyone was holding a ETF or a gold fund or an overseas fund today, which has been acquired post April 1, 2023, and if this was sold today, then one doesn't get the benefit of the amendment in the definition.
Okay. So it'll be only after 31st March next year when this will really be applicable.
Yes, and that too for after that, after the holding becomes long term. So one has to hold it for 24 months.
Okay.
And then post April 1, 2025, and then only you get the benefit of the 12.5% tax rate on such funds.
Okay. Now, so, of course, you're right, Vaibhav, there's a welcome change because where everything was getting clubbed into a debt fund and then getting taxed at the slab rate, now at least they have clarified it very clearly that no, everything is not a debt fund, which includes your international fund, FOF, asset allocators, etc. And they've clearly said only debt fund should be looked at as debt fund. But in terms of debt fund, which came in earlier, where they removed the indexation benefit from the debt term, from the debt fund, and they said now, but last time they grandfathered it, right? They said any investments we make before 31st March 2023 were kind of grandfathered. We didn't have to, we would still get the indexation and 20% benefit on it on a long-term basis. But this time around, they've not said anything like that, right? I mean, they've essentially said, if you hold debt funds and if you hold it for more than 24 months, then you're going to get a 12.5% long-term capital gain.
No, so in fact, they have said that. So any debt funds which have been acquired prior to April 1, 2023, they continue to be grandfathered. So if you were to sell them, holding them for 24 months, they will be taxed at 12.5%. Of course, there is no indexation benefit anymore, but the benefit of the long-term capital gains tax reduction will be available to such funds.
But the indexation benefit is gone.
Yeah.
Okay. Yeah. No, that's interesting because this, makes the debt funds a little bit more interesting compared to what it was before, where it was slab rates, specifically for, income taxpayers who are in the higher category of the income tax, right?
Yeah. I think the other big change that has come up is on non-residents' long-term capital gains on unlisted securities. So while we've been, everyone has been talking about reduction in the tax rates on capital gains on unlisted, assets and on immovable property.
Yeah.
When it comes to non-residents, the tax rate has actually gone up from 10% to 12.5%. So again, a change that will impact FDI returns. The only other change that has come in there is that earlier the 10% tax rate did not permit any exchange rate fluctuations to be adjusted, right? However, now with the 12.5% tax rate, the way the proposals are drafted, as of now, the exchange fluctuations will be available against the 12.5% tax rate, so which would neutralize some of the impact of the increase in taxes. It will be important to see as to what form and shape this finally gets approved, because if on the one hand, we are denying indexation benefit to residents on unlimited share sales, and on the other hand, non-residents are getting exchange rate fluctuation benefits, then somewhere the entire argument of providing a level playing field and rationalizing and bringing everything at par, somewhere that argument gets diluted.
Yeah, which was actually a big point in yesterday's budget, right? Simplification and rationalization. So,
Right.
so let's see how this gets taken up in spirit.
Absolutely.
Yeah. Okay. So we move forward.
Yes, now since we are talking about the indexation, no indexation, and the reduced tax rate, I just thought I'll cover this one first and then move to other slides. So what we've done is, given the reduction in the tax rate and the absence of indexation under the new regime, in this slide and in the next slide, we have played with certain numbers just to understand how the scenarios will pan out. So what we have done here is we have taken certain assumption that we have acquired share which is worth 100, and there's a 10x return after 10 years, and we have assumed annual inflation index change of 6%. Based on these assumptions, we have sort of compared what would have happened if we would have sold the shares under the existing law and under the new law, the proposed law. So I'm on the table on the left-hand side. Pre-change means before budget, post-change means post-budget. Now look at the pre-change. Sale price 1,000 because purchase price was 100, return was 10x, so 1,000. Since under the pre-budget, I would get the index cost of acquisition. So the index cost would be 180, considering 6% annual inflation index change on 100. 1,000 minus 180 is the gains. And based on 20% tax rate, the erstwhile tax rate, the tax was 164. And if you look at under the new scenario, the sale price will be 1,000, simple cost 100, the gains will be 900, and based on new tax rate, the tax will be 112.5. So based on this, what appears is that the new tax regime is beneficial. But now if we tweak the assumption a bit, say for a minute. Now suppose my return is 2x and the period is only 6 years. Then if you look at the antecedent rate tax, which is 11.5 for pre and post 12.5, it changes. So in a nutshell, what it means is the higher the return, the higher will be the benefit under the reduced tax rate without indexation.
Yeah, and I think of course time will also be a function of it, but that's a good way to kind of see that the higher the return, the higher will be the benefit, right?
Yeah. So there could be a position when even in the absence of indexation, but depending on the return, the reduced tax rate will be beneficial.
Interesting.
And I mean, this is in that sense, quoting from what Mr. Ramdev said yesterday, that while everyone is talking about increase in capital gains taxes on listed equities, the tax will arise only when there is capital gains, right? And if there is a scenario where the capital gains are going to increase because the market is so bullish, then the increase in taxes should not really hurt anyone. I think the message is very loud and clear from the government also, that if the rate of capital formation in the country is going is at a very high rate, then one should not really be hurt a lot by the changes that are happening, whether it is increasing the tax rates on listed equities or taking away indexation benefit on unlisted equities.
Yes. So that's a good observation, because that's the clear intent of the government, right?
That's right.
Also having said that, we did get used to from 0% capital gain tax to 10% capital gain tax and still the returns have been fairly good. So hopefully we all will get adjusted to the 12.5% capital gain
Yeah,
tax.
and given the markets are moving, it's actually we can achieve a neutral position.
Yeah, yeah. Okay.
So we ran the same thing in respect of real estate.
Yeah.
So again, some assumption, the purchase price of the property is 100. Suppose appreciation in 10 years is 3x. And again, the annual inflation index change is say 6%. So we change the sale price is 300, which is 100, 3 times of 100. Again, the index cost of acquisition is based on the inflation index change, which is 180. The difference is the capital gains, and based on the 20% tax rate, the tax is 24. In post change, without index cost, but based on simple cost, the gains is 200. And based on 12.5 tax rate, it is 25. So, given the way it has been provided herein, we can see that the benefit of reduced tax rate, it is getting offset because of the removal of cost indexation. Even in this case, also, if the sale price increases and return increases, you can see a benefit.
Yeah. So if you have to sum it up, because real estate forms a large part of the Indian household savings, right? And all the way from retail to fairly affluent investors. If you would have to generalize this, how would you generalize what category of investors would benefit and who will not benefit, right?
I think the way I would look at it, Rahul, is that purely in the context of real estate, right? I think the end users, right, who would want to hold on to real estate for longer periods in time, and where we've seen the percentage appreciation hence tends to be lower on an annual basis, right? I think they are, and again, it depends on each, various markets as to how the overall real estate prices are moving. But generally speaking, end users holding on to real estate for a longer period of time may not really benefit. They may feel the pinch of indexation benefits taken away a bit more than investors who would then trade in properties more frequently.
Okay. Yeah, because for them, the one who are on a shorter period of time and are more frequently trading in property, the indexation benefit anyways was not significant, and they were at 20%, and now they are at 12.5. So yeah.
Correct.
Okay.
In fact, I'm aware of a few friends who called me yesterday to say that their property prices are wherever they are, and these are end-use properties. But they are saying even some pockets interest rates are not getting recovered, the interest costs are not getting recovered. However, with this change, while there are no real returns, but just indexation going away, there will be a significant tax if they were to sell the properties today. These are people who have been holding on to properties for 15 years, 20 years.
Yeah, those would be the ones that are going to face challenges at the moment. Interesting. Okay.
Next is the buyback of shares. So this is again an important change. First of all, the new provisions will be applicable from October 1, 2024 onwards, not before that. Now, till now, buyback was taxable in the hands of the company, not in the hands of the shareholders. That was the law. And the way it used to happen was whatever money was paid by the company, it was considered as a sales consideration for the company. And whatever amount company would have received on the shares bought back, that formed the cost. And the difference was subject to buyback tax, which was effectively 19%. Now, it will be taxable in the hands of the shareholders, first point. Secondly, it will be taxed as a dividend. The entire proceeds received by the shareholder will be taxed as a dividend. Okay. No offset will be available in respect of the cost of the shares or any other expenses. It will be plain vanilla dividend. Since it is a dividend, there will be withholding of 10%. In case of non-resident shareholders, withholding will happen based on the applicable TDS rate. Now, at the end of the day, the shareholder was holding some shares, right, which was wiped out. So whatever was the cost that will be available as a capital loss in the hands of the shareholder later on. It can't be offset against the dividend, of course, but later on, if there are any capital gains event, it can be offset against those gains.
Okay.
So this is a big change that has happened now.
So why they've taken the buyback and now they've made it tax slab rate. They have given some benefit in terms of capital gain, right? Because I'm able to take off losses against those shares which I've tendered in buyback, and I've got positively tendered.
So Rahul, what I understand is conceptually buyback is nothing but akin to dividend. That is how it is being portrayed or projected since now. And we have seen buyback happening, and this is considered to be one of the most effective route for taking out money at an effective tax cost. You all know, right? Now, taking that argument forward that it is nothing but dividend, right? They are simply saying that whatever money you are receiving, that will now on considered as a dividend.
Yeah.
The logic is as simple as that. Before reading the fine print, we were expecting that when it will be taxed in the hands of the shareholders, it should be taxed as capital gains rather than a dividend.
Okay.
We were expecting that. But now it is what it is, actually.
I think the only thing that I would add here, Rahul, is that even if it is treated as dividend, and it is a deeming provision, right? It is not dividend per se, it's a deeming provision. And if you look at those deeming provisions, there are other existing deeming provisions in the income tax law, section 2, subsection 22, right? Which covers cases like, any distribution on a liquidation of the company or on a capital reduction. All of those are limited, dividend is limited only to the extent the company possesses accumulated profits or reserves, right? And hence, anything distributed over and above the profits, which is, let's say covering the cost of the shares, that was getting taxed as capital gains. In this case, they have taken, they've made a deviation from that overall principle, where they've not used that term to the extent of accumulated profits. Maybe a drafting error, but the fact that they have carried the capital loss change to capital gains doesn't look like a drafting error, looks to be thought through. But looks a bit inequitable, because you are then looking at it from a time value of money perspective. For investors who are losing significant value in terms of their investment cost in the shares being bought back, they have to wait for a capital gains event to happen in their life or to be able to offset. It's not that offsetting this capital loss against this dividend is allowed in the same way. That's not allowed. So you'll have to then wait for a capital gains event to happen, and this capital loss will have a life of 8 years and not more. So from a timing perspective and a cash flow perspective, it definitely is a bit off. And so I was speaking to a friend who runs a real estate fund, and he made a point to say that their exits from the project SPVs, they do residential projects, are in the form of buybacks out of these SPVs, because when the project gets sold, then the only way to exit is for the company to do a buyback and distribute cash and for them to exit. Now this becomes a big issue, big challenge for them, because if they are not getting offset of the cost, then they're effectively paying taxes on everything, including what their own investment.
Right. No, I remember writing about this last year, where there was a clear increase in buyback by promoters, by companies, right? Because essentially what they would do is a dividend, and typically in these companies, the promoters were the largest shareholder. So the dividend would get taxed at, more often than not at 40%, but the buyback was, getting taxed at somewhere around 22%. So they were able to slash their, their tax outgo by almost half. right? Unfortunately, I think that loophole has been plugged now.
Agree.
Yeah.
Okay.
Hopefully, the provision of section 80M should be applicable and available, as in whatever the shareholder is receiving. Suppose the shareholder is a corporate shareholder, if it pays out such money as a dividend to its shareholder, then possibly no tax for the tax for the shareholder which has received the buyback consideration in the first place.
Okay.
Because at the end of the day, it is considered as a dividend.
Mm.
Personal tax, there's a marginal change in this. So no change in the slab rates under the old tax regime. However, people who have opted for the new tax regime under section 115 BAC, there has been change in terms of the slab rates. So old slab rates is on the left-hand side and the new slab rate is on the right-hand side. So if you see 3 lakhs to 6 lakhs slab, now it has been increased to 3 lakhs to 7 lakhs. 6 lakhs to 9 lakhs slab, it has been increased to 10 lakhs, 7 to 10. From 9 to 12 has been increased to 10 to 12. And rest it's same.
So if you really look at it, I think there is a saving of about maybe about 15,000 overall.
Yeah.
Because of this change tinkering in the slab rates, where on the 1 lakh which is being shifted from the 15% slab effectively to the 5% slab. So there's a 10% saving. So there's a 10,000 saving there.
And standard deduction has been increased from 50,000 to 75,000.
So that 25,000 into 30% tax rate is a 7,500. So that is the 17,500 math that the government has been talking about.
Yeah. And whatever contribution employers are making for the employees, that will be available as deduction. It's just that the rate has increased from 10 to 14%.
Okay. So clearly from this, it seems that the government wants more and more people to kind of shift to the new tax regime. And I think, if I'm not mistaken, majority of the people who are filing tax have already shifted to the new tax regime.
Yeah.
Yes, sir.
Okay.
I think the only comment that I would make there is that while leave apart all other allowances and exemptions which are not allowed in the new tax regime, I think the fact that they're not even permitting savings like ATC kind of investments, PPF, and your insurance policy premiums and all of those things. I think somewhere from government, the push is not so much on personal savings or retirement savings, but more towards spending and consumption.
No, that's an interesting insight. That's an interesting insight. Yeah. So that's why you said consumption seems to be the theme of this budget when they're saying starts.
Yeah.
Disincentivize saving to some extent, but we're going to push it more towards the consumption.
Agreed on.
Okay.
There have been changes in the TDS TCS rate. So as you can clearly see, the TDS rates have been sort of slashed in almost all the cases. There have been few new entrants in this list. Remuneration interest payable, the second last row, I'll say. The remuneration interest payable by partnership firm to the partners. Now, whatever is being paid to the partners, this will be subject to TDS rate of 10%, which was not there earlier.
On a lighter note, that impacts cash flows for all of us.
And in case of sale of luxury goods, value exceeding 10 lakhs, again, there will be TCS of 1%. The nature of goods, they are yet to be notified, but yes, they will be notified, and anything above 10 lakhs, they will subject to TCS at the rate of 1%.
So this one is an interesting one actually, because this is again directed towards towards the high income group. So far only the cars above a particular value were subject to this TCS. Now they are saying they will expand the scope of this entire thing to bring in more and more goods. One could suspect things like watches and expensive wearables and stuff like that to be included within all of this. I think this one will be an interesting one to watch out for.
In fact, reduction in the rate of TDS is also welcome change. But yeah.
So essentially, I think this 1% that they've got on the sale of luxury goods is to kind of keep a track, right? On
Yes.
if what you're spending is commensurate with the income that you're declaring.
Correct.
Right.
Okay. Yeah.
Other important changes, the critical being the evaluation of income tax. So just to give a perspective, and people are aware of it, but still, that as of now, whatever money is being infused by residents or non-residents in Indian entities, exceeding the fair value of that entity, that was subject to tax in the hands of the company at MFR. Now we all know people used to take valuation report justifying the fair valuation. But still, regulators have challenged those reports. There have been litigations, plethora of litigations, and still going on.
Yeah.
So they are not agreeing to the fair valuation and everything, and so on and so forth. Now, this abolition means now we can infuse money at premium. Of course, it will be still advisable to open valuation report because there has to be sanity around it. But we should be also mindful that though this section has been abolished, as in if premium is being infused, as such 5627B, the so-called section is not there, but there is section called 68, wherein regulators may ask question on the source and the nature of whatever money or premium has been infused in the company.
Okay.
So that ability they still have, and they can ask the shareholder and the company the nature and source of the money. And if asked, that has to be sort of justified.
But this is a welcome change, right? I think
Absolutely
this is a
welcome
big
change.
point.
It's a big relief.
Yeah.
This is a big relief. So next is the rental income from residential property. This will now be considered as income from house property, not as a business income. So this is a debatable position, especially where the residential property were housed in the company, entities, or for the developers. Because the question was whether for them it will be considered as a income from business or income from house rental property, house rental. Now this debate has been put to rest. It has been clearly specified that any rentals from the residential property will be covered as the income from house property. Again, a small change, whatever TCS you have paid, that can be given as a credit in respect of TDS deducted for the salary. Is a small change, but a welcome change. One more change, which is covered earlier but not discussed till now, is that under the existing tax laws, any gift made by person to anybody or settlement of assets in a trust, they were exempted from capital gains tax. That was a plain, simple exemption. Now we have seen corporate giving gifts to other corporates or to other persons, and they have been litigated simply on the ground that gift can only happen between two natural persons because it is based on natural law and affection, so on and so forth. So now under the proposed change, it has been clarified that gifts, settlement of capital assets in a trust, etc., can only be exempted if they are given by individual or HUF. So that is one of the important change which is there. Secondly, in respect of shares which are tendered under offer for sale pursuant to IPO, now it has been clarified that they will get index cost till FY 17-18. There was a huge debate around that. What should be the cost of acquisition for the shares tendered pursuant to OFS, whether they will get indexation or not, and so on and so forth. But now everything has been put to rest. They will get indexation till FY 17-18 whenever shares are tendered pursuant to OFS going forward.
I think that's an interesting and important change because with the flurry of IPOs that we have been witnessing, right, promoters or existing investors tendering their shares under the offer for sale route, it helps provide clarity because we are aware of all sorts of positions being taken and all sorts of advices being going out from various advisory firms as aggressive as saying that because the existing fair market value definition under section 55 doesn't cover a situation for an offer for sale, can one say that there is no capital gain tax at all because the computation provisions itself fails, the computation machinery fails, and hence, one doesn't need to pay any taxes. There have been other views to say that fair market value as per a valuation report of January 31, 2018 should be taken, and that should be taken as a cost. But I think it puts all of this, speculation and varying positions to rest and provides complete certainty on such sales and such sales.
Yes, yes. I think one of the things this budget clearly has done is given a lot of clarity on some of the things that people used to,
No, absolutely. If
they
you
have
keep
questions around, right?
reflecting on, the way this government has been bringing out budgets in the last, couple of years at least, the focus clearly has been to simplify taxes, right? While as a, tax practitioner, as a tax advisor, I don't really like taxes getting simplified, but I think in the overall scheme of things, it's very welcome. It really helps improve the overall investment climate of the country. Foreign investors looking at us, the Indian capital markets have been so buoyant, largely dependent on domestic institutional cash flows and retail cash flows, and not so much dependent on foreign FPI cash flows anymore. I think bringing certainty, and removing or reducing litigation at all points in time is very welcome.
Yeah.
Yeah, so I think those are the critical changes that have been there. There's some change in increase in the STT rates that you can see on the slides, not really consequential, more on futures and options trading. These are the substantive changes that have been announced. Very happy to discuss questions that may have come down.
Yeah. So, guys, if you have any question, you can put it on the chat box. I'm happy to put them. But one of the things wherever we've been asked is on the LRS, right? So as we know, there was a 20% TCS which was put on the LRS. I'm assuming that still stays. But the capital gains that we get from our investment of the LRS money, how is that going to be treated? Is there any change in that, or that's going to be treated in the same way as it was done before?
So it would effectively follow the same treatment, except the fact that the holding period now reduces to 24 months for all assets other than listed securities. And the tax rates also on such long-term capital asset goes down to 12.5%. But if it is sold short-term before the 12 months period, before the 24 months period, then it gets taxed at the maximum marginal rate. So nothing really changes on such assets. I think the only change, as we discussed earlier, is on the foreign funds, the international funds, which were here inadvertently classified within that debt mutual fund category, and they were treated as short-term, irrespective of the holding period.
Okay. And so basically on the LRS side, the indexation has gone away, right? It's after 2 years you pay a 20% and you and that's the capital gain. Right?
After 2 years, you get 12.5%.
Yeah.
Sorry, 12.5%, yes. So it's reduction. So again, indexation taken away, but gone from 20 to 12.5.
That's right.
Okay. And in terms of NRIs, right? Because a lot of the families we deal with, a lot of the clients we deal with, are NRIs, right? Or have global, or have the next generation as global citizens who are kind of coming back and are NRIs still. What have been the key changes for the NRIs?
So I think fortunately there has been no change on the definition of residency and the conditions for residency. I think they've already made it very stringent a few years ago, so they've let it be. I think there is no special change which impacts NRIs other than the change that impacts non-residents really, and overall the capital gains tax rates going down. So I think the 10% tax rate on unlisted share sales goes up to 12.5% as we discussed. However, the forex fluctuations, if you have bought those shares and sold those shares in foreign currency, then you get the forex fluctuations. So that is a important change. Aside of that, there is no specific change which is applicable only to NRIs.
And how about, so, I did my education outside of India, and we all opened the bank accounts, and, it's been 25 years, and those bank accounts are dormant, and, we try to declare it in our foreign assets, but some relief has been given around this, right? It's been made a little less stringent.
So all residents in India, okay, they have to declare all their foreign assets in their income tax return. Now, what used to happen is that, in a case like yours where there's an old bank account lying with some $1,000 of cash, right? Non-declaration of such assets invited a penalty. Okay? They have now liberalized it a bit to say that if there is a non-disclosure of foreign assets other than immovable property of the value not exceeding 20 lakhs, then penal provisions will not be attractive on such non-disclosures. So that's a change which is a good change for residents who happen to have assets outside India.
I think apart from this, there's one question that's more for me. The question is, how would the new STCG rate affect your PMS? By how much more marginally would it need to outperform the markets now in the long term, considering the increased taxes? So yeah, given that I do, we do run a PMS under SEBI umbrella called under Valtrust Partners, and the PMS scheme is Valtrust Momentum. Anything that gets sold on a short-term basis, which is less than 1 year, which earlier used to be taxed at, say, around 15%, now it's going to be taxed at 20%. And anything that the PMS sells after a year is going to be taxed at 12.5%. This is going to increase the tax that has to be paid by the investors. I can't put a number on it, because it really depends on how much short-term, long-term trading that we do. But essentially, if our blended rate of taxation, say between a long-term and short-term over the last financial year was, approximately 12.5 to 13%, it would go to somewhere around, 15 to 16% now, right? So I would say approximately a 2.5% kind of taxation on the capital gain may be additional. But again, these are estimates. I don't know going forward how much of the stock will be short term, how much will be long term. But yeah, I mean, that's the best guess estimate I can do. Don't think there are any more questions. But to all the attendees, thank you for attending. If you have any questions, please reach out to me, please. And if you have any questions for Vaibhav or Samudra, please reach out to me. I will forward it to them and connect you guys to them. Vaibhav, Samudra, thank you so much. I really appreciate you guys taking the time and taking us through some of the key basics which impact the investors. Any closing thoughts, guys, that you want to you want to say?
Thank you, Rahul, and been a pleasure with all the attendees. I think just as a closing remark, I think personally I would look forward to the next budget. I think the finance minister in that sense has set the stage by saying that they're looking at a comprehensive review of the income tax law. I would expect the next budget to be even have much more changes. So some of them, of course, will be positive, some will be negative, but I think keeping in view the larger objective of simplifying taxes, I would definitely very eagerly look forward to the next budget, which is maybe 9 months down the line.
Yeah.
Thanks for the opportunity.
Oh, thank you. And I think, based on what Vaibhav said, we are going to have another webinar soon after the next budget, because there are going to be more changes around there.
In fact, we should also look out for the fine print once it is signed.
Yes.
Whether there are changes or not, because that will again form an interesting proposition on certain aspects.
Yes, absolutely. Thank you so much. Thank you everyone who's attending. And as I said, if you have any questions, please shoot it out to me. And if you want to connect to Vaibhav and Samudra, please let me know. See you.
Thank you.
Thanks,
you.
guys. Bye. Bye.
Bye.